Think back to when you were a kid. There was fresh snow on the ground and school was canceled. You and your friends wanted to go out and play in the snow and make a snowman. When you first began rolling the ball of snow, it was very small and it took a long time to grow in size. However, as it got bigger, it took less and less time for this ball to grow and double in size. Now this analogy is literally the description of what the dividend snowball is. When you begin, it may seem like it's taking a tediously long amount of time for you to begin making a serious amount of money. However, when time goes on, you will begin to make more and more money in an exponential way. So in 20, 30, or 40 years, you may even be able to retire and live purely off of this income in itself. Today we're going to be diving into the power of the dividend snowball strategy, how long it will take you to begin making a substantial amount of money using this strategy, and some ideas for investments you can make which will help you to bring in this dividend income. If you guys do enjoy this video, I would really appreciate it if you would smash that big red subscribe button below this video. Most of the people who view my videos are not subscribed to the channel, and it's 100% free to do, and you can always change your mind later. The power of dividend investing really comes from two different things, and those two different things are time and patience. This strategy is 100% not a get-rich-quick scheme, and it may even take you years to begin making a substantial amount of money from it. However, the upside here is that millions of investors have been using this strategy for decades, so it does in fact work, and it is an amazing time to begin investing in this strategy right now. And that is because the market is down so much right now, which really increases the upside potential for your investment in the future. When you're thinking about how long it will actually take you to begin making money using this strategy, it really depends on how much you're actually investing, if you're reinvesting your profits, and how much the market is appreciating each year. So let's dive a little bit deeper into the actual figures on how long it will actually take you to make good money using this strategy. From 1976 to 2021, companies that paid dividends in the S&P 500 made around a 9.5% annual return on investment. Now this is including the dividend yield that is actually paid on top of the appreciation of the stock. However, this is compared to companies who did not pay dividends in the S&P 500 during this period of time, who had about an 8.2% annual return on investment. So if you invested $500 a month into these stocks and held it there for 40 years while reinvesting your profits, using this 9.5% historical annual return on investment, we can reasonably estimate that your portfolio would be worth around $2.3 million. Now, once you begin withdrawing some of these funds because you want to travel or you're retired, the return on investment you would be making would not be nearly as high. However, generally speaking, you can withdraw about 4% of your portfolio's value every single year. In this way, your portfolio will still be able to grow over time while you're also able to enjoy some of the funds you've made in the past. This meaning using this 4% rule with $2.3 million, you could withdraw around $92,000 every single year for the rest of eternity while your money would still continue to grow in your portfolio. And considering all of this would come from investing a mere $500 every single month shows the importance of starting investing at a young age. However, if you are a little bit older, you're not necessarily out of luck. So if you took the same $500 a month in 9.5% figures that we used earlier and invested over a period of 20 years, you would accumulate approximately $325,000. Now I'm sure from this you can tell that the longer you keep investing, the better, but $325,000 is never something to complain about. So if you use the 4% rule here, you would be able to withdraw around $13,000 every single year from your portfolio if you wanted it to continue to grow. This $13,000, when you add a 401k or a pension plan and social security benefits, also does set up a pretty nice retirement plan as well. However, this does go to show if you are interested in dividend investing, it is extremely important to start as soon as you possibly can. There are many different ways to actually go about this dividend investing strategy. However, I would say the easiest and the safest way for beginners would be to invest in an ETF which also has a good dividend yield. The Schwab US Dividend Equity ETF under the symbol SCHD is currently priced around $76 a share and has a dividend yield around 3.3%. Now you definitely could find individual stocks or ETFs that do have a higher yield, but generally speaking, if a company pays a very high dividend, it means they're not reinvesting a lot of their profits. If a company is not reinvesting back into their company, it leaves very little room for growth, which can lead to the stock going down in value over a short or a long period of time. Therefore, when focusing on dividend investing, I really like to see a stable dividend yield around 3 to 5%. This is because it means that this company or ETF is doing well enough that they can continuously pay out money, but they're also reinvesting back into the company in an attempt to keep the company growing as well. The second dividend focused ETF I personally really like is Invesco's S&P 500 High Dividend Low Volatility ETF. This ETF is under the ticker symbol SPHD and is currently priced around $45 per share and has a dividend around 3.8%. I personally really like this ETF because it has a specific focus on low volatility. This focus on low volatility means it will likely not grow as much during periods of growth. However, during times of uncertainty like the times we are in right now, it means it will likely remain a lot more stable compared to growth stocks. We can see this because in in the past year, the market is down about 20% and this ETF is up about 1.5%. Now these are the only two ETFs that I'm going to be specifically talking about in today's video. However, there are a lot of other good dividend focused ETFs out there, and it is important to remember to do your own research before investing, and also to remember that all investments do carry some amount of risk. Now if you are a much more advanced dividend investor with more money, you may want to build your own portfolio. A lot of people genuinely enjoy researching and picking specific dividend stocks that they want to invest in, and that's completely fine as well. And if that's something that you personally think you may want to do, I say go for it and give it a try. There is a good way to try out this strategy and to see if it works for you while also having zero risk, and that is called paper trading. Companies like TD Ameritrade offer paper trading software that lets you buy and sell mock stocks so you're not risking any of your personal money. This way, you're able to see if A, you enjoy picking these individual stocks, and B, how good you are at it as well. Many professional investors do not beat the market each year, but with that being said, it is possible to beat the market if you do try to learn and grow as an investor every single day. So if it were me and I was a beginner dividend investor, I would simply put my money into one of these ETFs and try paper trading first to see if it were right to me while still making a return on investment while having my money in these ETFs. I really hope that this video helped to show you guys that the sky is the limit when investing in dividend stocks. We really only reviewed if you were investing $500 a month, so if you invested $1,000 to $2,000 a month over 40 years, you would likely make significantly more. If you did enjoy this video, we are extremely close to hitting 100 subscribers, so I'd really appreciate it if you would smash that big giant red button below, and I hope to see each and every one of you guys in the next video.